This is part 2 of our Chapter 7 video lecture, where we pick up on stock distributions, or stock dividends, or stock splits. The general rule is stock dividends and stock splits are tax-free to the shareholder. All you're getting is shares of stock in the same corporation you already own. And before and after the stock dividend split, you own the same percent of that corporation. Okay, so generally it's a tax-free distribution. Let's say that you get now double the number of shares you used to have. Well, what you gotta do is now split the cost, the old cost, among the new shares. So whatever cost you had in the initial share, you would split it evenly among the new shares. Yeah, split it evenly among the new shares. So that's stock dividends. Now, if you're given the offer of either receiving a cash dividend or a stock dividend, that would make the stock dividend taxable. Okay, so most times corporations will just offer a stock dividend without any cash option. Let's talk about stock redemptions, where the shareholder is turning in shares to the corporation in exchange for getting money back. Now, it is possible for this redemption to be treated as a dividend, taxable to the extent of the corporation's earnings and profits. Or, if you meet the conditions of a true redemption, then it's treated as a sale of the stock or an exchange of the stock. Whatever proceeds you have, minusing the cost basis of the shares that were redeemed, will equal to a gain or a loss. Let's see. So here is the three conditions you need to meet. You need to meet to be treated as a redemption, that's a sale or exchange and not a dividend. Um, let's start off with this bottom one first, where it says the redemption is not essentially the same as a dividend, which is a very subjective statement. What you have to do is look at all the situations where the IRS has ruled a redemption to either be a dividend or an exchange on a case-by-case basis. Okay, so not too common for that one. This second one here, where the shareholder turns in all of their shares and agrees not to be an employee or be an owner for the next 10 years. In that situation, then the redemption is treated as an exchange and not a dividend. Possibly a more common one to be treated as an exchange is where you meet a test called substantially disproportionate. And you have really two different tests. One is a 50% test and another is an 80% test. The 50% test says that you cannot own 50. Your ownership after the redemption has to be less than 50% of all the shareholders. In other words, you don't control the corporation. Keeping in mind that if whatever your family owns, you're considered to own. If you own a corporation that also owns shares in the redeeming corporation, you may be considered to own those shares also. Same thing with a partnership in which you're a partner, may own shares in the redeeming corporation. We call that type of ownership indirect ownership attribution or constructive ownership. The 80% test is kind of indirectly saying that you got to reduce your holdings by 20%. So now you're down to 80% of what it was before the redemption. Here's that constructive ownership situations I mentioned before, and more detail is given in our textbook regarding specific family relationships like parent, child, and grandchild. Let's take a look at an example where we have Tom, who owns 60 shares out of a total of 100. So that's nice and convenient. He owns 60% before the redemption. So the question is now, how much does he have to redeem to make this redemption treated as a sale exchange versus a dividend. So you could go through a trial and error to meet that 50 and 80% test, but our textbook gives us this algebraic formula to figure it out. So here it says he has to redeem 24 of his 60 shares to meet the 50 and the 80% test. So let's test that out here by starting with a blank screen. So we have Tom that owns 60 shares, and we're told he's going to redeem 24 shares, leaving him still with 36 shares of interest in the redeeming corporation. The corporation has a total of 100 shares outstanding before the redemption, and here's how much they're redeeming for Tom. And after the redemption, the corporation will have outstanding 76 shares, of which Tom owns 36, or after the redemption, Tom owns 47.4% of the corporation, which is less than 50%. So here we meet that 50% test. The other test is that he has to reduce his ownership down to at least less than 80%. So again, here's how much he has left over after the redemption, and here's how much he had started with, and that comes down to 60% of what he had before. And again, that's less than the 80% test. Okay, so we meet both tests here. So this redemption is treated as a sale or exchange by Tom. In other words, whatever he has going to get from the corporation, cash or other property for market value, he can minus out the cost of the 24 shares he's redeeming, and the excess will be a capital gain, possibly long-term capital gain, or possibly a long-term capital loss if it's less than the basis, and it's not treated as a dividend. Okay. So again, a redemption that's treated as a sale exchange, you're going to have to report a gain equal to whatever money you get, minusing out the basis of the shares that were sold, or possibly a loss if you don't have any more ownership in the corporation. Here, the redeeming shareholder is not a related person anymore, then you can report the loss. Otherwise, you don't report the loss if you still have an interest in the corporation. And again, constructive ownership or attribution rules apply. So on the corporate side, they're going to have to reduce their retained earnings or earnings and profits. Here it says there's different rules. Well, if it's a dividend, we've seen in the previous video how to first use the current earnings and profits and then the accumulated earnings and profits. In the case of an exchange, we also have to reduce the earnings and profits, but by not necessarily the dollar amount of what was distributed, but the percent of the stock that was redeemed. So if you redeem 10% of the stock, you gotta reduce the accumulated earnings, the earnings and profits by 10%. Here it says, but not more than the fair market value of the cash or other property that was distributed. Partial liquidations is not a common type of transaction. We'll see full liquidations in the next chapter. Partial liquidations are typically when the corporation sells part of their business and distributes the money, the proceeds, to the shareholder. If you want to split up a corporation or distribute out a business to the shareholders, we'll see that as a reorganization also in the next chapter. Okay, so partial liquidation is not too common. Okay, so let's stop here and make sure you work on your Learn Smart practice problems, homework, and quiz for chapter number 7.